Gold hit a new high. Central banks quietly changed the game. Gold just did something that would have sounded almost unbelievable a few years ago. It surged to record levels. And for a moment, the entire financial world seemed to be watching. But here's the part that matters. The biggest gold story may not actually be the price. It may be who's buying it. Because while everyday investors are looking at charts, headlines, and gold coins in shop windows, central banks have been quietly changing the role gold plays inside the global financial system. And that shift could be much more important than any single price record. Gold has already experienced an extraordinary move. Earlier in 2026, gold reached an all-time high above $5,300 per ounce on the futures market before pulling back significantly. By early August, prices were trading closer to the $4,000, $4,100 area. So if you're watching gold today and thinking, it already went up, did I miss it? That's the wrong question. The better question is, why were central banks willing to keep accumulating gold even after prices had exploded? Because central banks don't usually buy assets for the same reasons you and I do. They aren't looking at a chart thinking, this candle looks bullish. They aren't checking whether gold is trending on social media. They're thinking about reserves, currencies, geopolitical risk, inflation, liquidity, and the stability of the international financial system. That changes the entire story. For decades, the modern financial system has revolved around fiat currencies and government debt. The US dollar became the dominant reserve currency. US Treasury securities became one of the most important reserve assets in the world. Central banks accumulated foreign currencies and government bonds because they needed assets that could be used for international trade, financial stability, and currency management. But something has been changing. Gold has been quietly regaining importance. And this isn't simply a story about investors becoming afraid. It's a story about diversification. Think about it from the perspective of a central bank. If almost all of your reserves are denominated in someone else's currency, you are exposed to that country's monetary policy. You are exposed to its interest rates. You are exposed to its financial system. You are exposed to sanctions. You are exposed to geopolitical conflict. And you are exposed to the possibility that the value of that currency changes. Gold is different. Gold doesn't belong to another government. It isn't someone else's promise to pay you. And when held directly, it doesn't carry the same counterparty risk as a bond or bank deposit. That doesn't make gold risk-free. It doesn't. Gold can fall. Gold can experience enormous corrections. It produces no interest. It produces no dividends. And when real interest rates rise, gold can become less attractive compared with interest-bearing assets. But central banks aren't necessarily buying gold because they expect it to outperform every asset. They're buying it because it serves a different purpose. It's a reserve asset. And that's a subtle but extremely important distinction. The World Gold Council reported that central banks bought an estimated 244 tons of gold in the first quarter of 2026, up 17% from the previous quarter. Poland and Uzbekistan were among the largest buyers during that period, and the broader trend didn't begin this year. Central banks have been accumulating gold at historically elevated levels. In 2025, reported central bank net purchases totaled about 863 tons, according to the World Gold Council. Now here's where the story gets fascinating. The World Gold Council's 2026 central bank survey found that 89% of reserve managers expected global central bank gold holdings to increase over the following 12 months. Even more striking, 45% expected their own institutions to increase gold holdings, and 83% believed gold would represent a larger share of total reserves 5 years from now. That doesn't mean every central bank is secretly preparing for the collapse of the dollar. That's an important distinction. It means reserve managers increasingly view gold as strategically useful, and strategic demand is very different from speculative demand. A trader might buy gold today and sell it tomorrow. A central bank can buy gold with a completely different time horizon. Years, decades, possibly generations. That kind of buyer can change the structure of a market. Imagine a market where millions of people are constantly buying and selling. Prices can move violently. But then you introduce enormous institutional buyers that aren't necessarily interested in selling every time the price rises. Suddenly, part of the available supply becomes effectively less responsive to short-term price movements. That's one reason central bank purchases matter, but there is another reason. The global financial system has changed. The world has experienced wars, sanctions, trade disputes, asset freezes, currency restrictions, and increasingly intense competition between major economic powers. These events force governments to reconsider what they actually want sitting inside their reserves. Because reserves aren't just about maximizing returns, they're about maintaining financial independence, and gold has one characteristic that makes it particularly interesting. It is no one's liability. If you own a government bond, someone owes you money. If you own a bank deposit, a bank owes you money. If you hold a foreign currency, you're holding another country's monetary system. But physical gold itself isn't a promise from another institution. It's an asset. That doesn't make it automatically superior, but it gives it a unique role, and that role becomes more valuable when confidence in financial institutions becomes less certain. This is why the gold story can't be separated from the debt story. Look around the world. Governments have accumulated enormous amounts of debt. Debt isn't necessarily a problem by itself. A growing economy can support debt. A government can refinance debt. A country with strong institutions can carry substantial liabilities. The problem appears when investors begin questioning the cost of maintaining that debt. Interest rates matter, inflation matters, economic growth matters, and credibility matters. If investors demand higher yields to hold government debt, borrowing becomes more expensive. That can create political pressure. It can create fiscal pressure, and it can create another reason for governments to diversify their reserves. Gold doesn't solve a government's debt problem, but it can provide a different type of reserve asset, and that's where the central bank strategy becomes interesting. They aren't necessarily replacing currencies with gold. They're adding gold alongside currencies. That's a much more subtle shift. Think about a household. You probably wouldn't keep every dollar you own in cash under your mattress. You might have a checking account, a savings account, stocks, bonds, property, maybe some other assets. Why? Diversification. Central banks think about reserves in a similar way, although at a vastly different scale. If one asset becomes too dominant, the institution becomes more exposed to that asset. So adding another reserve asset can reduce concentration. And gold is particularly interesting because its behavior can differ from government bonds and currencies. But here's where investors need to be careful. Gold going up doesn't mean the dollar is about to disappear. It doesn't mean hyperinflation is inevitable. It doesn't mean the financial system is collapsing, and it certainly doesn't mean gold can only go higher. Those are dramatic conclusions that the evidence doesn't justify. What we can say is much more interesting. The world's reserve managers appear to be assigning gold a larger strategic role, and the reasons behind that shift are unlikely to disappear overnight. Geopolitical uncertainty isn't going away. Government debt isn't disappearing, inflation risks haven't vanished, and competition between major economic powers isn't going away. These are structural forces. That doesn't guarantee a higher gold price, but it can create persistent demand, and persistent demand matters. Now let's talk about the most important misconception about gold. People often say, gold is an inflation hedge. That's only partly true. Gold's relationship with inflation is complicated. There are periods when inflation rises and gold performs extremely well. There are other periods when inflation rises and gold struggles. Why? Because investors don't react to inflation alone, they react to what central banks are doing about inflation. If inflation rises but central banks aggressively raise interest rates, real yields can increase, and higher real yields can make holding a non-yielding asset like gold less attractive. But if inflation remains elevated while monetary policy becomes easier, gold can become much more appealing. So gold isn't simply an inflation thermometer, it's part of a much bigger equation. Real interest rates, currency strength, liquidity, geopolitical risk, investor positioning, central bank demand, and expectations about the future. That's why gold can move even when today's inflation number doesn't change much. Markets aren't pricing today, they're pricing expectations. And that brings us to another powerful force, the dollar. Gold is generally priced in US dollars, so when the dollar weakens, gold can become cheaper for international buyers, potentially supporting demand. When the dollar strengthens, gold can face pressure. But again, the relationship isn't mechanical. Other factors can overwhelm currency movements. Geopolitical risk can dominate. Central bank buying can dominate. Investment demand can dominate. And that's exactly why the current gold story is so interesting. The metal has shown extraordinary strength even while the macroeconomic environment has remained complicated. And the central bank demand provides a structural layer underneath the market. But here's the question everyone wants answered. Where does gold go from here? $5,000? $6,000? $3,000? Nobody knows. And anyone who tells you they know the exact future price is selling certainty that doesn't exist. Gold could continue rising. It could trade sideways for years. It could experience a massive correction. All three outcomes are possible. Remember, gold already demonstrated how violent this market can be. After reaching a record high in January 2026, it subsequently experienced a major decline. By early August, it was still substantially below that peak. That's an important warning. A bull market doesn't mean a straight line. Gold can rise dramatically and still fall 20% or more along the way. So if you're thinking about buying gold because you believe it can only go up, you may be setting yourself up for disappointment. The better reason to own gold, if it belongs in your portfolio at all, is diversification. You don't buy insurance because you expect your house to burn down tomorrow. You buy it because you recognize that unexpected events happen. Gold can play a somewhat similar role in a portfolio, not as the entire portfolio, but potentially as one component. And this distinction becomes extremely important during periods of financial stress, because when everything is going well, investors tend to love assets that produce income, stocks, bonds, real estate, businesses. Gold looks boring by comparison, but when confidence starts disappearing, the characteristics investors value can change. Suddenly liquidity matters. Portability matters, scarcity matters, counterparty risk matters, reserve status matters, and gold starts looking different. This is why central banks may be thinking about gold differently than retail investors. They aren't asking how much will gold return this year. They're asking what role should gold play in our reserves over the next decade. That's a completely different question. And perhaps the most important signal isn't even how much gold central banks own today, it's what reserve managers say they're planning to do next. According to the World Gold Council's latest survey, a large majority expect global central bank gold holdings to continue increasing. That suggests the shift isn't necessarily finished. Now imagine what happens if that trend continues for another 5 years. You could have central banks accumulating gold, private investors accumulating gold ETFs receiving inflows, countries seeking to diversify reserves, and investors increasingly viewing gold as a strategic asset rather than simply jewelry or an inflation hedge. Demand doesn't have to explode for that to matter, it just has to remain persistent. But there is another side of the story: supply. Gold isn't like a company that can suddenly manufacture millions of new shares. Mining takes years, new deposits have to be discovered, permits have to be obtained, capital has to be raised, mines have to be built, and even existing mines have physical limitations. The World Gold Council expects mine production to increase modestly in 2026 as high prices encourage additional supply, but the growth isn't expected to be explosive. That creates an interesting dynamic. If demand remains structurally strong while supply grows slowly, the market can remain tight. But again, price itself changes behavior. High prices encourage recycling. High prices encourage miners to produce more. High prices can reduce jewelry demand, and high prices can eventually make investors more cautious. Markets always adapt. That's why the gold story is never as simple as central banks are buying, therefore gold goes up forever. No, markets don't work that way. Eventually, valuation matters. Interest rates matter, positioning matters, and human psychology matters. When an asset rises dramatically, people become excited. Then more people buy because other people are buying. That can create momentum, and momentum can create bubbles. Gold has experienced bubbles before. It has also experienced brutal bear markets. So the smartest way to understand gold isn't as a guaranteed path to wealth. It's as a unique asset operating at the intersection of money, politics, psychology, and scarcity. And that's why central bank behavior matters so much, because when the institutions responsible for managing national reserves start changing how they think about gold, they're telling us something about how the global financial landscape is changing. They're saying, in effect, we want more diversification. We want assets that aren't dependent on another country's promise. We want protection against certain forms of financial and geopolitical risk. We want optionality. That's not necessarily an attack on the dollar. It's a recognition that no single asset should carry all the risk. And this is where the story gets even bigger. For decades, many people assumed the global monetary system would remain essentially unchanged. The dollar would dominate. Treasuries would dominate reserve portfolios. Gold would remain important, but mostly as a secondary asset. Now that assumption is being challenged, not destroyed, challenged. And that's a much more realistic way to describe what's happening. The dollar remains enormously important. US financial markets remain enormous. Treasuries remain central to global finance. Gold isn't replacing the entire system, but gold is becoming more strategically important within it. And if you're an investor, that's the signal worth watching. Not tomorrow's gold price. Not the next $5 move. Not whether gold breaks another psychological level. Watch the behavior of the biggest long-term buyers. Watch central bank reserves. Watch real interest rates. Watch inflation expectations. Watch government debt. Watch the dollar. Watch geopolitical risk. Because those forces are much more important than any single headline. And there's one final lesson. Gold's rise doesn't necessarily mean the world is ending. It may mean the world is changing. There's a difference. When countries diversify reserves, they're preparing for uncertainty. When investors buy gold, they're often preparing for uncertainty. When governments rethink their dependence on foreign currencies, they're preparing for uncertainty. And uncertainty itself can become a source of demand. That's the quiet transformation happening underneath the gold market. The headlines focus on the price, but the deeper story is about confidence. Confidence in currencies, confidence in governments, confidence in debt markets, confidence in central banks, and confidence in the future. When confidence is high, people are comfortable holding promises. When confidence becomes uncertain, people start looking for assets that don't depend on someone else's promise. And gold happens to be one of the oldest examples of that idea. That's why it has survived thousands of years of monetary experiments. Empires have disappeared. Currencies have collapsed. Governments have changed. Financial systems have been rebuilt. And gold has remained. That doesn't make gold magical. It makes it unusual. And right now, the world's central banks appear to be taking that unusual asset more seriously. So the question isn't, should you sell everything and buy gold? The question is, why are some of the world's largest financial institutions increasing their strategic interest in gold? And once you understand that question, you begin to see the gold market differently. Because this isn't just a story about a metal becoming more expensive, it's a story about reserve management. It's a story about diversification. It's a story about geopolitical uncertainty. It's a story about debt. It's a story about the future of money. And perhaps most importantly, it's a story about a financial system quietly preparing for a world that may look very different from the one investors became accustomed to. Gold may go higher. Gold may go lower. Nobody knows. But one thing is becoming increasingly difficult to ignore. Central banks are watching gold. They're buying it. They're studying it. And they're giving it a more important place in the architecture of global reserves. The price is only the part of the story you can see. The part you can't see is the strategy. And that strategy may matter far more over the next decade than whether gold breaks another record next month. So the next time you see gold hit another high, don't just ask, how much higher can it go? Ask a better question, who is buying it and why? Because sometimes the biggest financial shifts don't begin with a crash. They begin quietly. One reserve allocation at a time, one central bank at a time, one vault at a time. And by the time everyone understands what changed, the game may already be different.